Let's start off. Welcome to the Traders Desk. We are on the 21st, 23rd of February. We'll look at a little bit of what's happening in the market, mainly around the macro backdrop, and do a little bit of price action analysis. Let's do a little bit of macro discussion and then price action analysis. I think these are going to be quite useful, especially as we head into markets that look like they're going to be a bit more volatile. So I want you guys to be well prepared for what's about to come. It could get quite tricky, so be prepared for that. Especially if you have risk in your portfolio, make sure that you understand that probably the market environment has changed, right? We'll get to know about that in the next few days of trading. But yeah, be on the lookout for these sentiment or regime changes in the market. Nothing that we discuss here is financial advice. It's purely for educational basis. And then all the material is copyrighted and owned by the Financial Traders Hub. So, guys, you would have heard me or you would have seen me share this chart in the Discord server, right? And we discussed this a couple of weeks ago on the webinar. This is the Magnificent Seven. So basically the top seven stocks in the S&P 500. These would be guys like Tesla and so on, right? So Microsoft, Tesla, Google, Meta, the usual suspects, right? So the reason we were looking at this a couple of weeks ago, now probably it appears to be very clear, is because I was, getting very strong indications that the leadership of the market was changing. So for a number of months, even years, right, you can see that the S&P was being led by this Magnificent Seven. So if I were to plot, let's say, I'm just going to hide this. If I were to plot S&P 500 here, right, you can see that these top 7, 10 stocks in the S&P 500, which were predominantly tech stocks, have been leading the market higher. Yeah. So it's very important, as I've mentioned before, that we always need to know if the market leadership has changed or is changing, because that will give us a very good indication of what could happen next, right? So as an example, let's say next week we have a break below this level. This is a bit of a problem, right? You can see that this is a bit of a support level for the last few, like maybe 2 months, right? From December onwards. If this breaks lower, and we already have companies like Tesla, which are probably down. Um, if I look on a monthly, maybe on a 3 months basis, Tesla is down. Actually, no, maybe on a monthly basis. So Tesla is down close to 22%, right? And by the way, just quickly, guys, do you know how to toggle between percentage change and price? Have you done that before? So maybe just make a note. Just press Alt and P. That's the shortcut. Yeah. So you don't have to go and manually calculate these percentage changes. You can just quickly have a look. And also you can move, it changes as you move the timelines, right? So this is a useful tool to have. But coming back to this, right? You can see that things are not looking great for Tesla, right? It's quite a big sell-off. And a large part of that is happening because Tesla now has serious competitors in China, right? Who are producing EVs in significant numbers and probably at cheaper cost too, right? So that's maybe challenging a little bit the leadership position of Tesla in EVs globally. And that's causing a bit of weakness to the stock. But why does this matter, right? Why does this MAG 7 thing matter? We know that maybe I'll ask the question to the group. So why are we trying to figure out if the leadership of the S&P is changing from the big top 7, top 10 companies. Why is that relevant?
I think it's relevant for the capital rotation idea, right? Like
Correct?
capital will be
Yeah.
rotating around,
Yeah.
away from these big ones to more
Hmm.
smaller.
Anyone else?
Also, it gives a direction of a market, right? So
Correct? Yeah.
which stock to focus on to
Yeah.
know a direction to sense a
Yeah.
pulse.
Yeah. And in post recessions, basically what happens is there is this saying, I think it goes along these lines: the generals are the first to fall, or something like this. No, maybe the opposite. The generals are the last to fall, something like this, right? So, in other words, what it's trying to convey is when these top guys who have been the leaders of the broader market indices start falling, it's a big downward pressure for the rest of the stock market. Why is this? Because we know that the investment fund space, they all have these top companies, right? They all need to have an allocation, and they're all trying to basically mimic the S&P or beat the S&P. And they can only do this by, or they think they can only do this by always making sure they have a significant weightage of these top 7, top 10 companies, which makes sense because if these companies have been leading the broader stock indices higher, you want to be relatively well allocated to these companies. But the problem happens when, these companies are starting to fall now, right? So a lot of funds are crowded in these top stocks. And if we start seeing, let's say, uh, Bhavan, you just shared a comment, right, that the VIX is now at 18 something. We all know that as the VIX goes higher, this causes a big deleveraging event amongst the investment community. So deleveraging basically just means, selling a large part of their holdings. Maybe not 100%. Maybe they start chipping, right? So let's say you had 100 million exposure to Tesla, you reduce it to 50 million, right? And that's creating a lot of selling pressure in the market. And you basically do this for your other 20, 30, 50 holdings that you've got. So everyone is going to be acting in the same way because they basically are mirror images of each other. So if this breaks down lower, we need to be well aware of this because VIX will keep going higher and this will trigger a big sell-off event, right? I'm not saying it's going to be a recession or anything of that nature. Corrections do happen in the stock market. The last time this happened was around July. There was a big correction. And it would not be impossible to have a 10, 15, 20% correction and for the market to grind up higher eventually. So that's a big thing that you need to be thinking about. As traders, we always try to find these shortcuts to kind of sift through and understand what's happening under the hood, right? The other thing is, give me 1 second, Darren. I'm trying to finish up on what I was saying. So the other thing is, you have to be very watchful of this move because if the top 7, 10 companies are now folding or falling, right? Chances are this is happening for very good fundamental reasons. So maybe there is an economic slowdown being priced into the market, right? So that will also have ripple effects to the rest of across the rest of the market, right? So this will cause more downwards pressure. So we are at this point where things could get really tricky, especially with the VIX ticking up. The last thing I wanted to say is you probably would recall my whole talk about the carry trade unwind. I think this time maybe it's not happening violently. It's happening, you know, in a controlled manner. And probably this is what we are seeing. But nothing is there to say that it cannot happen in one day or in 1 week or a couple of months. What is a bit more, I don't want to say certain, but what it looks a bit more plausible is that the downwards pressure will keep intensifying. So we might not have like a big crash like in July, August. We might just have like a sustained sell-off, and the market just keeps going lower every single week. So this is the USD versus the Japanese yen. So another week where it goes down. This was also a week, if I can put it that way. Because you can see, right, it tries to rally and then it's not able to rally above this. Then the market just sells it back lower. And eventually next week it heads lower. So I think as this sells off, there's a lot of tech that will get sold at the same time. Um, there's not a lot written around this, but there is at least from what we've seen in July, August, we know that there is a big part of that money that was borrowed in Japanese yen that has been invested in the tech sector. So the unwinding, whether it's quick, happens in one day or 3 months prolonged sell-off, means only one thing, more selling pressure on the tech sector. At least, that's how I see it. I might be wrong. And at the same time, you have inflation and everything creeping up. So it's a perfect storm for tech to underperform. Darren, go ahead. You had a question or you had something to add?
Yeah, so quick question. I don't know if you followed Warren uh, strategy, but he's just accumulating a lot of cash at the moment. And I just wanted to know your view about it. And is he sounding the alarm a bit about what's going
Um,
to happen?
Look, I don't really pay attention to that.
Mhm.
He's just one participant in the market. So he's free to do whatever he wants, right? This has no predictive value for me as a trader, right? The market is far bigger than Warren Buffett, right? He's been wrong in the past. He will be wrong in the future. He's a phenomenal investor, right? But we never put people on pedestals and then think that if they're doing something, then they must know something, right? He's been selling from December, if I'm not mistaken, or even earlier. Who tells you that he hasn't been buying a lot in February? you know, uh, he could have deployed all that cash that people are writing about in between. You would not know until the next 13F filings come out, right? And then the narratives will change again in April, whenever that report is out. Um, that's maybe it has value, maybe it doesn't. Who cares? We don't care about what one single individual is doing. I mean, he's been selling out of Apple, right, for quite some time now. Um, what has that done to the Apple share price? I don't know. I haven't checked in a long time. It hasn't done much, right? But does it mean that
I think he sold off.
this spells
I think
doom
he
for
sold.
Apple?
Mhm.
Maybe, maybe not. I don't know.
I think he sold off a lot of Bank of America stock and
Yeah.
then piled into Domino's for some reason. Uh,
Mm.
mhm. And then another question on USD and Japanese.
Mhm.
Why Japanese yen? I think it is mostly because of the interest rate,
That's
like
correct. It's because
gap.
of the divergence in the interest rate policy between the US and Japan. So the US is on a pause to cut interest rate trajectory, right? Japan are totally opposite. So, and they are only at, I think they're probably at zero point 0.5 now, if I'm not mistaken. Um, let's check quickly. Yeah, zero point 0.5. So they have a lot of room to hike. And the US has a lot of room to cut, right?
Right.
So that's like you're sitting in a very small boat, and then you have like a guy who weighs 200 kilos on one side of the boat, And on the other end, you have like a guy who's underweight, maybe
Right.
50, 40 kilos, and you're trying to balance that whole boat. Um, these are things you take note of, right? It doesn't mean that you definitely will have something
Hmm.
chaotic happening, right? But you have to take note of these things because history is a very good teacher, right? Uh, I think we discussed this maybe in the workshop, like the Asian currency crisis back in the 90s, Mexico pesos, the peg breaking and all of this. It has happened a lot of times in the past, and nothing is there to say that it cannot happen again. Here it's not pegged, but these divergent interest rate policies, they happen all the time. You just don't know about it because maybe you're not following a country like South Africa, India, Turkey, something in Southeast Asia, the Thai baht or something, right? We don't predominantly look at interest rate policies across the world, but there are places that have divergences. And Japan is predominantly important because it's a major world economy. And we know that people have been borrowing a lot from Japan to invest in the US, predominantly in tech. Yeah. So that's the reason, right? This is like a coiled up situation. Uh, and even I get nervous when I think about it because you never know how this will end up.
Right. And very quick follow-up on this, given that, we have like kind of a sense that, stock would be consistently selling off
Hmm.
in the near future. So what is the possibility of a bear market really
You mean in tech or across the board?
across the board?
Um, Look, it could happen, yeah. Uh, One of the things that's been ringing in my ears, and that again is from intuition, right? Since we had the CPI report with the PPI report, I think a few days later, there's just one word that's been ringing in my ears: stagflation. And I'm kind of refusing to listen to that word, because I'm like, no, we need to do more analysis. We cannot just jump to one word because, that's what your instinct is telling you. But, I mean, the more I think about it, the more I'm coming to the same conclusion. And stagflation is basically a situation, maybe for those who don't know, where inflation rate stays high and GDP growth slows down, right? And this is like strangling the economy, right? Prices are going down as the business activity is going down. Prices are going up as business activity is reducing. And there are things that you can take away from that. Maybe start looking at commodities. Maybe it's time for a commodity boom. If that's the case, how do you get exposure? Find a few companies that produce these commodities or maybe intermediaries of these commodities. I particularly quite like a few situations around copper, steel. So, I'm just giving you like another path to keep chasing, right? And that can be a high probability path too for you. If we have a bear market or not, I think it's a bit early. We are like right at the top of the stock market. We are more likely to print new highs than to be a bear market is basically defined as when the stock price is has fallen by I think 20% from the all-time highs, right? So S&P is like close to 600, 6,000. So if we get to 4,800 and about, maybe, yeah, somewhere here, right? This is where we'll get into bear market territory. We're quite far from that. It's not impossible, right? But this is not my original case at the moment. Can we get there? Definitely, especially if inflation just, takes the wheels of the market out. The other thing, I was discussing this with a few friends. What would you do if one day the Fed comes out with an emergency meeting and they say we are hiking by 50 basis points? What do you think will happen to the market? Because the Fed is hell bent on fighting inflation. They just have an emergency meeting. Emergency meeting meaning not even planned in the calendars. You just get a news release that the Fed wants to hike rates immediately by 50 basis points. That's going to be traumatic for the market, right? That's how we can get into a bear market. Go ahead. Yeah.
Hey Roshan. So I guess I was also thinking about the other economies. I think the
Mm-hmm.
UK, Australia,
EU as
reduced
well.
interest rates, and I mean they reduced interest rates by just 25 basis points, I think. So nothing major,
Yeah.
and they're not even they're not even close to where Japan is at the moment.
Yeah.
But I guess that would be another area that we should kind of keep a track of about like how these other economies
Mm-hmm.
um, proceed with their rate cuts or
Yep.
maybe rate increases in the future. But
So
that's another.
I'll share an insight with you. Since we've gotten into COVID, I've kind of used the Bank of England as a leading indicator for what the Fed will do. I've I've been thinking that they were probably 1 or 2 months ahead of the Fed. And that definitely stands true if you go back and look at it in history. So they started raising before the Fed, they started cutting before the Fed, maybe 1 month or 2 months, I don't remember exactly. And the question now is whether that correlation has broken or not. I think it's not as simplistic as this. But sure, if you're investing in those countries, or if you wanted to have a view specifically on their currencies or their equities, you would look at them individually using the same methodology, but then applying it to a different country's stock market. If you're looking for a currency trade, maybe this might be a better one. Uh, the Japanese, so being long being long GBP versus the Japanese yen. No, the other way around. Sorry, being short this currency pair. But that's again depending on what view you've got. The reason being here, so GBP, if they are cutting rates, that's putting downwards pressure on the currency, and then if Japan are hiking, it's putting upwards pressure on the denominator. So this is gonna, as a ratio, this is gonna come lower. That's as simplistically as I can explain it. Does that make sense?
Yeah. That does. Yeah, that's true.
Yeah. The other thing I was discussing earlier with a friend, and again, these are currency trading things, and we don't necessarily talk about currency trading in our forum, right? But I'm just sharing with you the discussions that are happening. So this is the euro versus the GBP, and I think there is a good chance that this could break below this multi-year support level. So the GBP stays strong, euro just craters, largely because of the euro not being as productive and not being able to get out of this whole deflationary cycle that they will eventually get into. And if I have to bet on the EU, that's probably the last game I want to play. I think they've proven that they're not a place that can be trusted with logic. Yeah, so what I wanted to show you next was also this RSP. Again, there's not much to discuss here. We've looked at this in the past. So what I wanted to show you is, again, what's the reason for us looking at this? This is the equal weighted version of the S&P 500. So this is giving us an indication of what's happening under the hood, not just the top 7, 10 companies in the S&P 500, but more across the 500 companies which are in various parts of the economy, different sectors, industries, and so on. So this is showing a little bit of weakness. And I would expect this to maybe trade sideways or even, keep going downwards. I wanted to also discuss this quickly. So the oil markets. So of course, this week, as we've gotten a little bit more of a growth scare, oil has taken a dip. So oil is basically just heading back to the low 70s, 68, that region. I don't personally know what will happen. There's a lot of things happening geopolitically, right? With Russia, with Saudi, and the Middle East. So that will have a big influence on where this goes. I think China is also kind of stimulating, but they have a very difficult time given that they are in a deflationary bust cycle, right? So far too much debt, and this is not something that can be resolved with one stimulative action from the government. But eventually it will recover, and there will be a time to be looking at China again. I think now is maybe premature. They're still experiencing a lot of pain, and we're also seeing slowdown in India, which is another big consumer of crude oil. I think India will have a little bit of a harder time. Uh, I think India will have a little bit of a harder time if the US and Russia join hands again, and Russia is able to sell its oil back to the rest of the world, because a lot of that oil was going to India for either refining or for shipping again back to other places in the world. So that activity will almost go away. And the Indian economy is also slowing down a little bit. So don't believe whatever you read from on LinkedIn with all these founders saying that this is the best place to be investing now and all. It's a great place to invest, right, for the future, but probably now things are not looking as rosy as they used to in the past. I was having this little joke with my friend the other day. A lot of times when you speak to founders or companies in India, they will always tell you something like, "Yeah, we're number one in this field," and then I would say to them, "But I spoke to your competitor. To your competitors, they all say they're all number one. So who's number two?" And then the room just breaks out in laughter. So that's just to say, right? There's a lot of hype, right? A lot of you know pretending, a lot of people who are not objective and who probably will not tell you things as they truly are, and maybe even far too optimistic, right? It's a great time for India, but these things are cyclical. They'll pass, and eventually it will become yet another great time for the country. But for us as traders, as we are looking at macroeconomics, we're not getting tied up into one country and what's going to happen and all. We're using these as a proxy to understand what could happen to oil demand in the future, because this will drive the price of oil eventually. And the reason we look at oil is because it has a big component when it comes to inflation, right? So if let's say oil goes to 80, that's not going to be good for inflation. If oil goes to 60, 50, 40, sure, it's going to be great for inflation. But if oil goes to 40, it could also mean that aggregate demand in the economy at a world level is just slowing down so quickly. So this is the thing that you have to keep in mind. I think it was Bhavan, right, this week, when you were saying housing is falling apart even if the US 10-year yield is dropping. You remember that comment, Bhavan?
Yeah, I think it was not housing, but tech sector.
Yeah, tech, right? You could say the same about housing too, right? Because
Yeah.
technically mortgage rates would be lower by virtue of long-term rates going lower. And we had established that, there was this inverse correlation. But these things break as you move into a new regime, new relationships come forth. And it's certainly true here too. Within a very small range, these correlations apply. But if oil opens up at $30 tomorrow, it probably is a sign of a global recession. So we are in a totally different environment, right? We're not in an environment where you should just be long risk asset because now CPI is going to be zero or negative and the Fed will be so happy. We'll have like a good 3 to 6 months of proper pain before the Fed starts stimulating again. So you probably would want to be net short risk assets. But these are all scenarios that you think about as a trader as you're setting up your portfolio. There is a very good report that comes out from OPEC. I think it's a monthly report. It's come out a few weeks ago. I would encourage you to flick through it, get an understanding of what type of data they provide. It's very detailed in terms of demand from most of the major economies, projected demand, current demand, as well as supply levels. So it gives you a very good picture of what's happening in the oil market. And it's important to be on top of this if you want to be trading stocks that have links to these sectors. Yeah, that's what I wanted to discuss. And obviously, as we speak of the long-term rates, we could see that this has sold off a bit this week, right? So the yield has fallen from, let's say, 4.5 roughly to 4.43. I think this is more of a growth slowdown being priced in, or maybe even a move from equities into treasury bonds as a safe haven as the equity markets sell off. But I think it's more of the former one, right? I found it quite interesting how the market did not move or even moved in the opposite direction when the CPI and PPI reports came out. So you would remember, right? The CPI beat or it missed expectations, which meant that it was higher than what was expected, and the market was kind of unfazed. So even if it was indicative of higher inflation, the US 10-year yields started falling, which is contrary to what we would expect, right? And then actually on the CPI day it rallied, but then on the PPI day it fell, right? So at the time I was not really understanding why this was happening, but now it's a bit clearer to me. I think the market is a little bit concerned about GDP growth and maybe pricing this in through long-term rates. So if you assume that housing rallies when yields go down, just know that this correlation has been broken now, because yields have dropped a little bit, and then look at what happened to housing as a whole segment. It had like a big day down, 2.75% at an index level, with many companies within the indices down 5, 7, 10%, right? So any questions so far, guys?
Sorry, can you mention again what did cause this dephasing, in your view,
Sorry, I didn't get that.
between
I
the?
mean, just repeat your
Um,
question.
yeah, I was just asking if you can repeat the reason or your view on the reason why this is dephased now. The fact that rates are not
Right.
increasing while the.
So, so long-term rates reflect a couple of components. One being long-term rate of inflation, right? Um, and the other being, let's say, your nominal growth rate, not nominal, but real rate of GDP growth, right? Over that period of time. So the yields are a reflection of the interaction of these two components mainly. There are other factors, right? Technical factors and so on. But I think the yields, long-term yields coming down was probably indicative of GDP growth slowing down in the future more than it was an indication that inflation has been conquered. You get my point, I mean?
Yes, got it.
Because for months we've been seeing the long-term rates rally as a protest against increase in inflationary pressures, right? And now it's not. I think the way to read this is not to say that, yeah, so the bond market is telling you that inflation is going down. No, because there's another big factor that drives these rates, which is long-term GDP growth too, right?
Okay.
So that's what we need to be very well aware of. And also, when there are big sell-offs, what happens is a lot of money moves from equities into the bond market. So if you're buying bonds, then the yields will go down. Yeah?
Okay.
Okay. So that's maybe we'll finish off by looking at so I wanted to look at the survey of consumers, but maybe we can look at this in the Discord server. It was another month of lower numbers. So I'm trying to see if I can get a chart. Uh, I think that's the one, right? The main site. This is like the old format of websites. Basically, just like a banner and then text. Like you could do this with HTML coding. Okay, let's look at the chart here, right? Um, You remember, I think was it last week that we were discussing this or 2 weeks ago? Yeah?
I think last week. No?
I think it was last week, yeah? So look at this, right? So last week, let's assume we don't have this red dot. So last week we were looking at this as, yeah, on the whole, consumer sentiment has been recovering well. It's volatile, sure, because it's a survey and so on. But then you have a print like this. This is a bit concerning. It's still a survey, but it's concerning, right? I don't think I've shown you this last time, but if you were to look at the responses split by Democrats versus Republicans, you would see that the Republicans have been optimistic in their responses, and then that's turned from January. So now both of them are agreeing. So you can see what's happening, right? Things are not great at the consumer level or not going to be great in the future. And we know that the US consumer accounts for around, let's say, 70% of US GDP. And coincidentally, we also discussed this, I think, 1 or 2 weeks ago, right? So you remember when I pointed to that week where somehow we stopped seeing consumer discretionary outperforming or being one of the leaders amongst the S&P or the sectors leading the S&P. You would recall that session, right? And I told you that this is probably a big sign of weakness because consumer discretionary has been leading many sectors in the S&P 500, outperforming for months, and then you come into, was it probably end of December? That's when the leadership changed and it moved from being an outperformer going to an underperformer. So when these things happen, you have to pay attention. So it could just be like a 1 week thing, and then it goes back, it rallies to new highs. But now it's looking like this is a complete reversal. Yeah. So if you're looking for short ideas, I will not be surprised that you start looking into the consumer discretionary sector. Yeah. Retail, uh, especially durable items like autos or boats, uh, recreational vehicles, pools, and all of this. Does that make sense? The
Yeah,
other
makes
thing,
sense.
Yeah.
I don't have a slide on this, but uh, I think I was discussing this with Bhavan, right? Where one of the home builders, I think it was Toll Brothers, yeah, where their clientele is more of an affluent base. And even they have started saying that they're getting challenges amongst that segment of the population. So the pain is probably widening from more your lower middle income segments, maybe now going into the affluent sections too. And if we have a stock market sell-off, then the whole wealth effect that people have in their heads, because the rich guys have a lot of equity exposure. Yeah. A lot of them are probably not rich, they just feel rich, right? There's a lot of unrealized profits, maybe crypto, maybe stocks, tech, a lot of tech. And they've probably overspent the money. And now, as the sector starts coming down, they'd be the first one to run away, you know? And you're not going to see these guys buying new cars or, buying new houses. That wealth effect can disappear right away. And you also don't have a situation where the Fed can cut anytime soon if inflation keeps going higher. So that's a little bit of a gridlock situation, right? Whereby the Fed cannot come to the rescue even if it wants, unless things break materially, which is not happening because the job market is still holding up and so on and so forth. And inflation keeps going higher. So that's one thing I wanted to show you. I think we discussed this last time too. So there are three things that come with this survey in terms of the report. So one of them is consumers sentiment on the current economic conditions. So how do they feel about the situation now? I'll make this bigger just so you can see, right? So let's go to January. We're looking at this number. So how are you feeling now about the whole economic situation? That came at a 75 level. And just for reference, anything above 70 historically means GDP positive. Yeah. So, people are in a good mood or consumer sentiment is recovering. And then in February, that's a big drop, right? We go to 65.7. It's been a long time since we've had like such big drops. Maybe the last time was somewhere here. But now this drop is also like making a new low, right? But it's kind of breaking this whole uptrend now. And this is why the market got really concerned. There's another question that they asked them. It's not here, but they asked two questions on inflation. One is, what is your expectation of inflation in the next year? And what's your expectation of inflation in the next 5 years? So they answered 4.3% for next year, the expectation for next year's inflation or next 1 year inflation. And the estimates were at 3.3%. So that's a big miss, right? So on the one hand, they're expecting higher prices. And on the other end, they are showing that they are not as confident, with the economy. And it's not going to be a surprise if consumer spending slows down from here. So if you're looking for short ideas, you could look into the retail ETF, find a few names within there, or you could go to consumer discretionary. Um, you find a few names here. Obviously, do your proper fundamental work before putting any of these ideas. Maybe in the Discord server, I'll discuss one or two ideas or one of you can take that task as you wish, as long as at the end of the day it gets done, right? So let's just look at sector and industry leadership, and then maybe we can close the session. Is that fine with you guys?
Yep.
Okay, super. So yeah, this is one thing I was looking at. We're not yet seeing a lot of stress in when it comes to defaults and so on. But if the consumer weakens significantly, these will start creeping back up. And as these, this is basically indicative of credit risk in the economy as it's priced at the moment. So credit risk going higher is gonna cause a sell-off in equities, right? And you can see for many years, it's kind of just been trending lower, right? Almost like we haven't looked at it in a year or so. During COVID, this is basically during COVID, you can see, right? So during the lockdown, you have a heightening of the credit risk, and that causes equities to sell off massively. And then the Fed proposes a few stimulative actions that comes down meaningfully with all the stimulus, the checks, and all of that. That government later on adds to all the fuel that the Fed is also pouring. Then the credit risk goes down lower. Then we have the hiking cycle. Credit risk goes higher because, of course, a lot of companies are leveraged, and if you have higher leverage and rates are going higher, you're at a higher credit risk, right? This is something you can look at in your own time. Keep a look on it because if this inflects from here, things are going to move very, very quickly. And Darren, to your question, if this inflects, keep an eye on it because that could be indicative of us eventually getting into that bear market territory. Okay, sectors now. So S&P was down 1.6% on the week. Across sectors, we had quite a few sectors that managed to be up on the week, right? So please feel free to unmute and share your own views on what you're seeing. My first question is this a risk on or risk off move if we look at the weekly performance?
Risk off by far.
Why would you say this?
We've got consumer staples right on top, utilities. These are all defensive sectors, energy,
Yeah.
healthcare. So all the defensive sectors are performing above market average.
Yeah, that's absolutely right. So last week, you remember we were a little bit in two minds, right? Is it risk off, risk on? Energy is still rallying, but consumer discretionary selling off hard. Consumer staples were still up a little bit, so it wasn't that clear. But this week, it's a lot clearer, right? Consumer discretionary, big sell off for reasons we've mentioned, and that's not just a weekly. The sell off hasn't started this week. If you see, it's down 5% on the month, right? So that has started much earlier, much before the consumer sentiment report. Then consumer staples being the best performer of the sector. What is this telling you? Clear risk off, right? People are hiding from discretionary, selling discretionary and buying consumer staples just to go hide, right? So it's a classic anti-cyclical move. So consumer discretionary is highly cyclical, right? Consumer staples, these are things like your toothpaste, soap, uh, hand lotion, all of these things that you buy even if you're in a recession. So this is a clear-cut move, right? And even on a monthly basis, now it's so clear. So consumer staples up 5.9%, discretionary down minus 5.4%. So guys, do you see the value of just taking a 5 minutes look at this, right? Do you see the value of doing this week in, week out?
Yes, absolutely.
And like I've mentioned in the past, right? It's not something that has incredible value if you just look at it on a weekly basis as a snapshot and then not come back to it next week, right? So this week, as the market was turning, I started sharing this maybe from Thursday onwards, just to keep people aware of what's moving in the market. And now this is like super insightful, right? Because this is basically like the footprints of capital. What is capital doing, right? Utilities being the second best performer, again, another clear-cut risk-off move. Healthcare, which has been selling off since November. Now it's the outperformer, right? Energy is up, right? Still up because I don't know, for whatever reason, right? I mean, the oil price is down, but energy is still up, but down on the month. So I'm not going to read too much into that, but you're seeing clear-cut signs of risk off versus risk on. Financials is another sector that has been doing pretty well. And now we have a negative print. So basically, it's given back all its monthly performance, right? This week has just wiped off all the gains from the start of February. This is how you need to look at this and interpret it. Industrials, prolonged consistent sell-off. Materials, of course, sell off again. Tech, the big one. A couple of weeks ago in the webinar, I did mention that tech had been the outperformer amongst all the sectors for months, and then somehow that 1 week everything turns, and now we're just getting continuation of tech being weaker. So as you're finding trade ideas, you have to be well aware of the prevailing winds in the stock market, right? And also be aware of why or what's driving those winds, because that can also be flipped on its head. So always be very, very fundamentally focused, right? Don't look at price action in isolation and say, because consumer discretionary is down 3.79%, it has to be down another 2, 3, 5% next week. That's not how it works. You have to understand why it's down and whether that is going to continue, or is this just like a one-off, right? So yeah, things are not looking great for Russell 2000 either. It's not in here, but we can find it here. So this whole theme of, the stock market broadening, it's getting challenged now. You can see that, right? It's broken this support level, this trend line. It remains to be seen as to where this will go next. But if this breaks down lower, I think this whole move that we've been waiting for, mid caps and small caps to lead the way for the S&P is not going to happen, or for the market rather. It's probably not going to happen yet. And then when you see a clear-cut move towards risk off, you'd be mad to be like overweight small caps, right? You could have the best fundamentals. The market is just not looking at small caps. They just don't want to see small caps in their portfolio in that kind of environment. Does that make sense, guys?
Yes, it
Yes.
does.
So I think this week we're getting very clear-cut, straightforward indications of where the market could be heading next, right? And these types of analysis, again, it's not rocket science, right? Any one of us could do this. It just takes a little bit of looking at this every single week, practicing, identifying the moving parts, and remembering what you saw in the last couple of weeks and painting the whole picture, right? I mean, you want to say something?
No, sorry.
Yeah, go ahead. Go ahead.
No, actually, I was just unmuted
Okay, no
because I
problem.
said
No problem. Let's quickly just look to the industry level now. Look at this guy. So he's now just woken up and he's doing his rounds looking for food. It's a little bit like sharks circling you, you know? That's the only time when they all work in groups. Like 99% of the time, it's a lot of bickering. But when it's time to ask for food, like all four of them, they'll do their thing in sync, right? Anyway, let's not get distracted. Yeah, so in terms of industries, one interesting one was the gold miners, right? So I think gold has made a new high, if I'm not mistaken. Yeah, so it made a new high this week, closed a bit lower, but during the week it was up, right? So to see gold miners not holding on to their gains was a bit surprising for me. Maybe it's a bit of profit taking, especially as the market is coming apart with the whole risk assets thing getting sold a little bit. So that's one thing to keep note of. Keep an eye on it. If you're long like a gold miner and stuff, be careful here. The market might just be saying, look, I see more risk here in that this company will have margin pressure and so on. And I don't really care if the gold price is going up. So that is the problem. I think there was someone who asked about gold miners. Yeah, and my response was, sure, that's a good link to make between, a gold price being higher, which means higher revenues for gold miners. But it's a lot more nuanced than this. So especially with bigger miners who have properties where the resources are always getting depleted, and it's always getting more expensive to run these resources because you have lower tonnage with time compared to what you used to have in the past. And typically what would happen is they will extract the they will exploit the parts of the deposits that are least expensive first, right? To try to make to try to get an early payback on their investments. And then towards the end, they will start exploiting uh, parts of the deposits which are probably deeper and require a lot more investment, building mines, underground and so on. So, as a retail trader, you would not be aware of all these shenanigans, right? So, if you just think it's a one-to-one relationship, you might get lucky and the trade works. But you have to always do your work. I think I've said this a few times. Link your dopamine pathway. In other words, get pleasure with the whole research process. Do not link your dopamine or pleasure pathway to making returns on options or whatever, because then that's going to lead you to seek the truth and exhibit all the right behaviors of a good market participant in financial markets. Right, so it's not a surprise that most industries sold off, right? Software and internet were big underperformers, especially on Friday. There was like a big puke of these stocks. So obviously we are long a couple of situations in software. I know some people are long GitLab and BlackBerry. We were long Pinterest, so that's something that maybe we've already all taken out now. So just be wary that the situation has changed, right? It's no longer the same situation whereby tech would just go up because there's nothing else to do. we're not in that environment. I still believe if you have good fundamentally positioned tech companies with no crazy share stock-based compensation and all of this nonsense, I still believe this could be good longs, especially if we have a quick recovery in the tech sector. But in general, this is a sector where you probably will find shorts, and then you'll find a couple of shorts and then maybe one long to counterbalance things. And as you know, with markets, right, this sell-off could last for a week, and then 2-3 weeks later, it's all back to highs, and then the sell-off starts again. So be very careful of this. Be careful of where your expiries are, and trade accordingly, right? It's another one. Not a surprise that home builders are amongst the worst performing industries here. On the week, on the month as well. Look at this, 10% on the month. And I'm not going to rant, but you know my view in terms of how great an opportunity many of you have missed, right? Not just to make returns. That's besides the point. The opportunity to learn as something is happening, and to let the situation, let yourself experience it viscerally, because that's not something I can replicate. The market has to move in that direction, so you experienced it viscerally. And if you haven't participated, maybe now I would not recommend that you start finding shorts and you now put ideas into your portfolio. But you've kind of missed that sweet spot where you should have been positioned and taken advantage of the gifts that the market was giving you.
Sorry, I shouldn't hear you because you were saying it's only starting.
Yeah, but
So
see, let's say we have another month of let's say -8%, right? It's not going to go down in a straight line, right? It might recover, it might rally a little bit, and then it goes down properly. So if you haven't participated, of course, I will never tell you on Monday, you short 5 of these companies. No. If you haven't participated and you kind of want to play catch up, then do the fundamental work again. But don't jump back into it. Don't feel like you have to pull the trigger. Do the work, identify your companies, run it through me, run your thesis and etc. from me. Then if the market gives us a chance, we can identify that and use this as a way for you to get a good entry with sensible risk rewards. Is that making sense, Amin?
makes sense.
Because if you go on Monday and you short something, chances are maybe by Friday it's 5% against you, right? Then you feel panicky and you're like, maybe I've done something wrong, right? Whereas if you are prepared and you're waiting to pounce on the opportunity, as the market gives that to you, which has happened a lot, right? If we look at the housing sector, this is the home builder in the ETF, right? So the start of the sell-off was in October, right? There's a big sell-off here in December with the Fed and everything. It went below this 200-day moving average. So if you looked at this, right? So pay attention to this. Let's say in December we're talking about this. We're doing January. We are doing this workshop, right? We're probably around here in January, right? Maybe somewhere in between these two candlesticks. So if you just look at this and then you get very excited, you're like, yeah, look, technically it's broken. Roshan is saying this and it looks very bearish. So let me just find 3-4 companies and buy puts on them. Look what could happen, right? You get squeezed out. You have a week where everything just goes against you. Why? I don't know. Maybe people are getting excited about Trump getting into power, the inauguration, or, they get excited on something he said, and they think that the housing sector will now, recover. Trump is going to be the panacea for everything. This is the stock market, right? Week in, week out, you have wild fluctuations. But the clever way to play this would be somewhere here, you're starting to do your research. You're taking note that the market is not agreeing with you, but the fundamentals look good. And then you're like, okay, I'm not going to put it because it's rising here. And then it has another week where it's up, but then at the end of the week, it closes lower. So you take note of that, right? And then you're like, but it's still above this red line. I want it to come lower, and then I'll start adding my shorts. And then in your thesis, you'd also see that this is a catalyst rich period, right? So from here onwards, you'll start taking action. Maybe you'll pull the trigger somewhere here, right? Or even here, or even here, or even, I mean, here yeah, I mean, Monday, Tuesday, Wednesday, that was like the time to do it. So where do we go from here? I think we've broken this level, so we could go another couple of candlesticks lower, or we could even rally back and attempt to test this level again. And then it fails, and then the ETF just goes, much further lower, right? We've seen a few situations like this. Which stock was that? Maybe this? Don't remember. No, this is not the one. I cannot recall exactly which one. BC. I think BC is the one I'm looking for. Yeah, look at BC, right? This is like a boat manufacturer. But look at the price action technically. It breaks this 200-day moving average, goes lower. So if you short it here, you're dead in the water. Or even here, if you short, you're not going to make money because it's going to rally very quickly. And as it rallies, it's trying to test this area again for months, right? And it's only here that it starts to break down lower. So if you were shorting it, you probably would do it around earnings, and maybe it won't work, or you maybe will get out with a little bit of profit. But the right time to do it was when it was conclusively established that it's unable to rally above this region, which you can see, right? There's a lot of resistance here, and then it just goes lower. And now it's like trying to make a new low, and this could go much further lower. Of course, there's a lot of fundamental things happening in between. It's not just a pure technical situation, but that's how you need to be looking at things, right? I mean, you need to be prepared first, and then wait for your chance to bounce, right? These situations
Definitely, yeah.
don't happen in 1 week, right? It could be
Yeah.
that we see this for another 3 months, right? But all I'm saying is maybe Monday, Tuesday is not the right time to pull the trigger, because you might be getting in at the wrong spot, and then you'll get
Yeah.
whipsawed, right? And you'll just
When did
mess your head. Yeah. Go ahead.
just curious? So, may I know when did you get in the home builders?
So I've been trading this quite a bit. I think I've played part of this segment, right? That was like me
Okay.
being very early. And then, so I've probably got in here, somewhere here. Yeah, maybe in between these two. Yeah.
Okay.
We have to look exactly when we started this discussion on SST. That's probably a good indicator. 1 second. Where's SST? So this is the thing I don't like with Discord. It loads and there's all of these things. So 4th of February, that's when I'm discussing SSD. So that's probably when I'm looking at other names and putting positions too,
Okay.
right? Because even for me, right, it's not clear, right? when the thing is going to happen. There's so much noise, especially with the price action being so bullish and all of that. And to be honest, I mean, even I was looking at this and just wondering whether I'm wrong on something here, right? Because the market was just not agreeing with me. So I probably shorted it in between these two. Yeah. But not XHB. It's individual stocks.
Yeah.
Yeah. So let's see if we've covered everything in the industries. Not much that's up, eh? Of note, agriculture is up, even if the news around agriculture is probably not the most bullish. So Nutrien has reported this week. I think Mosaic will report next week too. So keep an eye on these. These are fertilizer producers. There's a bit of talk that with the US, chopping off the legs of US aid, that's not going to be great for farmers because there used to be big demand from US aid for a lot of the farming products. So I don't know what that means for this sector. Just keep an eye on it. We'll know when is the right time to pull the trigger. I think it's becoming obvious that sooner or later, we'll see a meaningful rally in agriculture. And a lot of these low PE value stocks, especially if we pick the right ones, I think there's a lot of upside here. So, Bhavan, interestingly, insurance was down on the week. I think that's probably in sympathy with financials. Right. Regional banks is another industry that has been doing really well, and now a big underperformer. So keep an eye on this. As Darren mentioned, Warren Buffett seems to not like Bank of America for whatever reason. It's maybe because they have the biggest commercial real estate debt amongst all the banks. Possibly, I don't know. Yeah, but just keep an eye, right? Because the market, it's possible that the market has changed and now different things will rally and different things would sell off. Just to finish off, let's quickly look at the factor analysis. I think I shared this on Friday or Thursday in the Discord server. So capital is seeking the safety of large cap value. That's very clear on a monthly basis, on a weekly basis too, right? To the detriment of everything else. Everything else is just getting murdered. So my whole thesis around capital rotation to low PE value stocks, I've been chirping around about this from, I think, the workshop in, or even December, if I'm not mistaken. I think now we're getting clear-cut signs that this is about to happen. So get hunting, start looking for ideas in these segments. Of course, don't have 100% of your longs from large cap value only. But keep in mind, right, this is what the market is giving credit to. And the others have a bigger hurdle rate to climb over before the market can see them. Yeah. Okay. Is that clear, guys? Any questions?
Yeah, I have one question on construction, Roshan.
Yeah, go for it.
So do you have a separate or different view for commercial construction, or you think
Um,
that,
not as of now. I was trying to find a bit of data on this yesterday, and then I basically realized it's time to go to bed. So I haven't yet kind of developed a core thesis around this. Obviously, towards the last half of last year, what we were seeing was that commercial construction was still very hot, right?
yeah,
I think if we look at it in terms of prices, it's still indicative that commercial construction is retaining its value, but we have to be a lot more focused on companies that are involved in that activity per se, right? So, as an example, you have this company, right? Otis. It manufactures elevators. You've definitely been in one of their products, right? So if you go and look at this company, the management will tell you how its industry is doing. There are others that are involved in, let's say, I think this one is roofing, if I'm not mistaken. Uh, I think this is roofing. Yeah, residential ceiling wall, commercial and residential ceiling. So if you look at their earnings report or investor presentation, they'll give you stats on the industry, and it's broken down between residential and commercial. So sometimes you won't get like an industry standard economic report. You'll have to find your clues through these guys who have meaningful exposure to these industries. Yeah.
Yeah, makes sense.
But then just a last note from my side. I know we discussed probably in December that the whole theme of US infrastructure, and I said that it's probably a clever way to play it through the contractors, right? Because they are capital light and, they have the expertise, and even if there's inflation, they're not going to be impacted that much. The tailwind for projects is going to be creating more revenue for them in the future. Do you remember that discussion, right?
Yes.
So we have to be a bit careful here, because if Elon Musk starts investigating and starts cutting a lot of these contracts because of things that have happened in the past, if we have a trade on one of these companies, uh, we'll get seriously impacted. Yeah?
Yeah, that's true. And then even though it don't happen, the market might be anticipating something will happen and it might not agree with you, right?
Yeah, exactly. I mean, these are not risks you can assess adequately, right? What we know is when there's a change in administration, it's a bit like ping pong, right? One day this guy is in favor, the other day this guy is in, he's losing all the business, and it's a way to kind of take revenge from the previous administration and the people surrounding them. And it's even worse because we've seen clear-cut cases of corruption, right? So if one of these companies are actually involved in corruption and there is evidence, it's going to be a big mess, right? The CEO will lose his job, the stock will be down 50%. You don't want to have to deal with this. Yeah.
True.
Uh,
One more
you,
thing, Roshan, like you mentioned about inflation being a tailwind for commodity prices.
uh-huh.
Do you also see it's being a tailwind for agricultural stock?
It should be, but I'm not sure of the timing yet because
Okay.
of this thing I just discussed with you. Also, we have to see what's happening. I haven't done a refresh lately. I haven't looked at Nutrien yet. I have to look at this and understand what the outlook is on the industry. There's a bit of concerns also around Brazil because they are like a big farming country. They are like a big consumer of fertilizers. So if something is happening in Brazil and it's going to reduce the demand for fertilizers, we have to be aware of this. Um, I'm suggesting maybe there's a boom case for commodities, uh, predominantly from the stagflation perspective. Yeah, because you can have a situation where because there's been such prolonged underinvestment in many in many commodities like copper like number of copper mines that have been brought online in the last 10 years, I think it's very few, and it takes 8 to 10 years to get a copper mine from deposit stage to building a mine and producing copper. And there is a deficit between copper demand and copper supply. So if you get into a bit of a GDP slowdown, but copper demand holds up. Inventories are getting depleted, and you don't have new sources of copper production. You can see how that will cause the price to go up significantly, right? Because in commodity land, even like a 1 to 3% deficit can make a big difference to the underlying commodity price, and vice versa on if it's a surplus. So anything that we do, we have to do proper research. Run it through me. I'll give you a lot of pointers. I'm very well familiar with these areas. I've done a lot of investments in mining and so on. So yeah, I know a lot of the shenanigans, the dynamics that move the market and so on. It's also a great opportunity for you to, learn a new sector and benefit from, my knowledge, expertise, or, whatever you want to call it. You were looking at this company, right, Bhavan? Generac Holdings.
Yeah.
So I think these guys produce generators, basically a lot of electrical products, right? Generators, transformers. I think that's basically what these guys do. They have domestic and then commercial, right? So these are the type of uh, low PE value companies that I think we need to start getting a fresh look into. Mainly, this whole AI or capex in AI being at all-time highs, right? If data centers are going to be built, more of them are going to be built, you'll need more power solutions, you'll need more cooling solutions. So, that's going to create demand for a lot of these companies. Yeah. We don't necessarily need to go and look for Nvidia or even a company like Lumentum Holdings, for instance. It's a high PE play, and it's a bit of a risky play now, given the environment that we might be stepping into. Make sense? So,
Yeah.
ideally, what we are looking for is, a situation like, let's say, Mosaic, where you buy it at 25 and then buy options expiry, maybe it's at 31, right? And you're very happy, right? It's like a straight run up. You don't have to stress a lot about it. It goes to 31, 32. You've made 300, 400% on your position. You're a happy camper, right? You don't always want a situation where you're trying to be the hero and you're getting punched by the market and eventually you win that fight. That's if it happens this way, you still take the win, right? But ideally, you don't want to be in that position. Okay. Do we have any last questions? Anyone? No questions? Um, okay, so let's maybe close it off here. But when you see this ALGM, it's holding up well. Eh? It's gotten a bit of a sell-off on Friday, but it's holding up quite well.
Yeah. I think I was reading their earning report,
Mm-hmm.
and the positive thing about that is the flat projection for auto market in US. And they were
Okay.
saying even if the auto market is flat, they will always outperform because the move towards hybrid and EV
Yeah. Yeah.
is going to be a big tailwind for them. And the
Yep.
market seems to buy it.
Yep. And I think the US is going to be it's going to have a lot of competition from the likes of China and India as well, which
Yeah,
are getting better at producing these vehicles commercially and producing it cheaply. So, the US will no longer have the luxury of waiting for demand and supply to correct and all of that. Especially with Trump, right? This guy has put import tariffs on cars, and that's coming on the 2nd of April. He said, we're not going to put it on the 1st of April because people might think it's April's Fool. But it's going to be bit of a problem for, the whole industry. I mean, imagine you're producing most of your cars in Mexico and Canada, and bringing that back to the US is going to be like, I don't know, 10, 15, 20% more expensive. And it's not like you can just say, okay, screw that plan, we'll build our factory tomorrow. These things take time, right?
Yeah.
Exactly, and like even more so that he wants to impose tariff on others. But if you look at, for example, in this space,
Mm,
Tesla,
mm,
for example, most of their sales are outside the US.
yeah.
So if, for example, mostly in Europe, so if Europe starts putting barriers as well, so
Mm-hmm.
the US will suffer a lot from it. Whilst
Mm,
you mentioned about
yeah.
the Chinese brands like
Yeah.
BYD,
Yeah.
these guys, 75% of their sales are in China.
Mm,
So they
mm,
won't suffer from
yeah.
this
Yeah.
environment. So
Yeah.
they don't care if you impose
Yeah.
tariffs or not. These guys are still selling three
Mm,
times more than Tesla.
yeah.
So
And BYD has been, they've done really well, from where they came till now in terms of uh, how advanced the cars are, how much more high quality they are, but at the same time, how affordable they are compared to the ones being produced in the US. And China is a little bit demonstrating patriotism as well. The local, the people will be buying locally. They all know that the country is in a
exactly.
big problem, and at the same time, the US is hammering them, right? So they will support their local companies. I think Apple will eventually have a very, very hard time in China.
Same for Apple. Same for Apple.
Yeah.
Yeah.
Uh, Many of these other brands that are in China, US brands, I think they're going to face a situation where the population will just say, we're buying local. We're not going to give money to these people who not just disrespect us, but on the world stage of vilifying us, which is what's happening. It's not my view, right?
Yeah.
I'm just thinking of it from a human behavior, human reaction perspective.
Yeah.
The whole thing with Trump, though, I think he's using this as a negotiation tool. So maybe if he says 20% tariff on Canada, he starts off with the worst outcome, and then he'll try to secure a win by saying we only impose 5-10% tariffs. That's probably where it's going to go. And then he'll paint that as a win, and the market will look at this and say, we were expecting 20, we got 5 or 10, we're happy with this, and we keep on rallying. I think this is a situation that could happen. Everyone thinks about the headlines and everything, but you have to think about Trump and his way of negotiating. He announces something publicly, and eventually what gets done is probably at a lower level. So he still gets his stuff done, first of all, and maybe he only had 5-10% in his mind. He wrote that down as a win going into the negotiation. But then he sets the stakes so high, he says, okay, we're going to do 20. And when you get only 10, you celebrate. And at the same time, he's getting his desired outcome. So that's, I think if you follow him, you would realize that is his negotiation style or tactic. And of course, you'll have retaliatory tariffs too. I think something we haven't discussed, and it gets a bit more geopolitical now, right? But he's siding with Russia, and he's just put the Ukrainian president aside, right? He's already written tweets about him, and not great things to share about him. So It's like taking diplomacy to a whole different level. Um, but in other words, he's also saying, I'm not going to listen to you, right? So the discussion is between me and you and Russia. And Zelensky, of course, he's now running to EU to find support. In that whole mess, I think the war will get resolved, which is great. But then the US and Europe will have even more tensions. Because let's also not forget, between the US and EU, it's not a love story, especially with Trump, right? In his first term, he literally did something that was totally unexpected by calling them out and saying they don't contribute to NATO proportionally, they should be contributing more, and all of these things. They have regulations and whatnot. So this is a storm that's been brewing for a long time, and Trump is doing nothing to reduce fuel in that situation. You see, that's a bit problematic because Europe has been, almost like an ally of the US for so many years, right? Economically, there's a lot of trade with the US and EU. The other question now is what would the UK do? The UK is the best ally of the US. Who knows if if the UK says, I'm not okay with all of these things, right? I'm not okay if you negotiate with Russia and Russia takes half of Ukraine, and that's the deal you come and put in front of us. We're not okay with that. This could be a problem. So the US loses its allies in EU. If you lose the UK as an ally, I think that's a big change to the world order, right? The UK is under a lot of stress, but historically it's been a very, very strong ally militarily, right? That's these are all the things happening that maybe doesn't get talked about or written about too much, but it's happening, right? So you have to keep an eye on these things and understand what could be the knock-on effects if, let's say, tomorrow the British Prime Minister starts making public statements about his, uncomfortable position with what's happening with Russia and the US. Let's say he says, "Okay, I'm gonna pull out of the talks," right? This is gonna be a big change in relationships. And as you know, right, it's similar to, let's say you have a friend or a wife or, good relationships. It's not like you can slap someone a few times and then come back and say, okay, this was wrong, right? You've already messed up the relationship. It's it's irreversible damage, right? And my biggest fear is that US loses the UK as an ally, which would not be good for the world. That's my biggest fear. But yeah, I mean, lots of scenarios. Not like a geopolitical expert either.
Yeah, it's already happening actually. UK is already siding by Europe and with a lot
Yeah,
of discussions with
I
France. But
mean,
I was thinking in terms of geopolitical
mhm.
impact of these Russian discussions, there's a lot of talks that the Western companies would go back to Russia.
Mm, mm,
Maybe
mm,
is this a theme that we can also look at? Maybe companies who had been present in the market who might
mm.
benefit
You,
from that.
you could look at this. There's a lot of US capital stuck in Russia. There's a lot of investment funds that have had their holdings frozen in Russia, right? So I suspect a large part of Trump wanting to get everything resolved is also due to this, right? And of course, if you open up the Russian economy, you get more oil that's now free flowing, not sanctioned oil. And that brings a little bit of a, uh, downward pressure on the oil price. But also, Russia is open for business, so that creates opportunities for US companies. There are a few things you can look at. Maybe it's a bit too early. So, because of course, remember, with what's happening in Russia, companies are not going to be like super excited to go and deploy massive capital there, right? It's still it's still a country that is suffering economically, right? So anything consumer driven will be a bit strained, right? Uh, what you could look at in terms of a thematic trade could be maybe companies that would be involved in the reconstruction of Ukraine, right? If the war gets resolved, there's a lot of reconstruction that needs to happen in Ukraine and maybe in Russia too, or predominantly in Ukraine, right? Uh, there could be a lot of Ukrainian companies itself, but do you want to get involved in that? Maybe not. Maybe a few European companies, maybe even a few US companies. That war being resolved also means that this whole situation around Ukraine is a big producer of wheat, of oats, and some agricultural commodities. So with the war ongoing, there was a little bit of risk that at some point, shipping lines and stuff could get blocked, and all these supplies coming from Ukraine could get hit, and basically overnight you have the price of bread that goes through the roof because one of the major producers is no longer exporting. So they managed to keep that going through the war, and with them reopening, I think it would just mean more supply going into the market. So not a good situation if you're expecting agricultural commodities to rally, but probably a good situation if you're expecting food prices not to go through the roof. So these are the things you have to think about. There would be other themes. Maybe an opportunity I was thinking about was, and this is very niche. So basically, look at investment funds that are listed where maybe they got hit with the whole Russia thing, and now maybe they'll get a bit of relief and they'll be able to get back these assets that they had written off completely. But these are difficult to find, especially to find a listed name and play them. You'd really have to do your research here. Yeah, I mean, I generally would not participate that much on this situation. Another play could be shorting defense companies in the US because they were getting a lot of contracts because of the war, and especially if the war between Israel and Palestine also gets resolved, then the Lockheed Martins and so on, they've already fallen a lot, but there could be further downside.
In
Okay,
Europe as
guys.
well, yeah.
Anything else? I think we've gone over time. If we have any burning questions, now is your time. Otherwise, we'll end the session. Okay, doesn't look like we have any questions. So, guys, keep an eye open for the market. VIX is creeping up. So, remember what I've just said. We're getting into we could potentially get into a new market regime, and things could get a little bit tricky if you don't know what you're doing. For guys like us, this is when it gets exciting. We really like this environment. And yeah, you'll hear of my ideas a lot more in the Discord server. And also keep in mind what we've discussed at the start of the session. I really want to see you guys become independent traders. So you're sourcing your own trade ideas, playing them confidently, having a portfolio that's well diversified. That's the end goal. And we have to figure out how we get you to that stage. Okay? Okay, guys, cool. Have a lovely weekend. Last few hours of the weekend.
Thanks a
Okay.
lot,
Thank
Roshan.
you.
Thank you.
Take care,
Thank you.
guys. Bye bye.